Welcome to Standard & Poor's August Loan Market Overview clip. I'm Steve Miller, a member of Standard & Poor's Leverage Commentary and Data team, which is ring-fenced from Standard & Poor's rating agency. For the next 5 minutes or so, I'll walk you through a review of recent loan market trends before winding up with some themes to watch for in the month ahead. For real-time updates on the loan market, please follow LCD on Twitter, Facebook, and LinkedIn. You've all seen this before. It's a disclaimer that's long and detailed. Please read it at your leisure. With the capital markets rallying and technical conditions firmer, the Standard & Poor's LSTA index bounced back in July, posting a 1.5% gain after suffering 2 straight monthly declines. Through the first 7 months of the year, loans have returned 4.9%. Stronger technical conditions were also in play in the new issue market, where yields stabilized in July after spiking in June. Yields would have likely dropped more forcefully had not issuers rushed into the loan market to take advantage of improved demand. Loan market technical trends were largely unchanged in July. The outlook for demand, however, improved markedly. The strong rally in equity prices put IPOs back on the table for many issuers. As well, the high-yield market caught fire, raising hopes that takeout deals will reignite in the month ahead, and in doing so, pour more capital back into the loan market. Default rates continued to recede in July to their lowest point since late 2008. Higher earnings are largely behind this feel-good trend. Loan prices bounced back in July in response to improving technical conditions and a rash of better-than-expected second quarter earning reports. LCD's flow name composite, shown here, is a sample of the 15 largest names in the market. The composite traded up 2.6% in July to around 93.5 after declining a total of 4.5% in May and June. Year to date, the average is higher by about 2%. With the secondary up and technicals firmer, new issue yields eased a bit in July. On average, new issues printed at 7.7% during the month, compared to a 9-month high of 7.8% in June, but still far above May's 6.4% average. Looking ahead, arrangers bracket BB new issue yields at 5.5 to 6.5%, B plus B1 yields at 6.5 to 7.5%, and BB2 yields at 7.5 to 9%. These ranges are wide to account for different levels of size and complexity. How well an issuer is followed also plays a role. This chart shows the return by month of the S&P LSTA Loan Index. As mentioned before, the index was up 1.5% in July after dropping 34 basis points in June and 2.3% in May. Over the first 7 months of 2010, loans have returned 4.9%. That compares to a gain of 8.4% for high yield and a slight loss in the S&P 500. In July, with the bulls running again, lower rated credits outperformed. BB loans were up 1.1%, single B loans 2.4%, and triple Cs 1.9%. As this chart demonstrates, volume was lower in July, despite a flurry of large launches, including Fidelity National's $1.5 billion dividend loan and Cedar Fair's similarly sized LBO loan. Altogether, arrangers rolled out $9.6 billion of new issues during the month, down nearly $1 billion from June's tally. Looking ahead, August volume is on pace to beat expectations as issuers take advantage of muscular investor demand. Warner Chilcott's $2.25 billion dividend deal is one example here. Further out, arrangers say the post-Labor Day calendar is mounting, with volume potentially reaching levels not seen since early 2008 before Lehman's bankruptcy sent the markets reeling. Still, this volume will be far below the bull market levels of 2006 and 2007. Market fundamentals continue to improve in July. During the month, the lagging 12-month default rate dropped to a 20-month low of 3.5% from 4.1% in June. A scan of Capital IQ data shows why. On average, leveraged loan issuers posted a 12% increase in year-over-year EBITDA during the second quarter. Through the first 7 months of the year, the default rate is running at an annualized pace of 2%. That compares to a peak level of 10.6% from last November. To wrap up then, some final points. With the capital market strong, most participants think that technicals will continue to favor sellers in the near term, with late August doldrums likely to put a lid on volume. The real test will come after Labor Day. If volume indeed is as strong as many expect, technical conditions may well cool as supply surges. Of course, demand may also trend higher as a result of repayments from IPOs and bond takeout activity. Since July 1st, no fewer than 5 large leverage issuers, including Skype and AMC, have filed equity offerings. As well, in early August, Rite Aid, Building Materials, and Tembec came to market with takeout high-yield issues. Defaults, by all accounts, will slide further even if the economy continues to bounce along. Most buy-side managers see a year-end rate of less than 4%, and the run rate so far this year is just half that. That brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description for this video below. We plan to update this analysis monthly, and we'll have other videos as well.